I'm going to give you 25 years of hard-won investment knowledge in the next 20 minutes. This is going to allow you to out-invest 99.9% of people. None of this is going to be generic. I'm going to be breaking down my portfolio and talking about the sectors I'm watching as I go. Who am I? My name's Nick Bencino. I started trading and investing at 15. I turned 1K into over 52,000 in my first year, and I thought I was a legendary trader, but I wasn't. I lost it all very quickly because I was in fact clueless. But that was the start of my 25-year career. I've made millions in my career. I've lost millions. I've made them back. I traded through the tail end of the dot-com bubble in 2001, the 2008 crash, COVID in 2020, and everything in between. I learned a lot of lessons along the way, and today I'm going to condense them into 5 brutal truths for you. And I'm not going to give you the usual be patient, hold strong, trust the process rubbish. I'm going to give you examples, talk about my actual current portfolio, and I'm going to go deep. I'll answer the actual questions I'd be asking if I was you. Before I start, I'm not a financial advisor. This is not an inducement to buy or sell any specific assets. And as always, do not take financial advice from some random dude on YouTube. Let's get started. So brutal truth number 1, it's not about being right, it's about making money. This is the one that took me the longest to learn. Most people are obsessed with being right. My wife is a key example of that. She's not. She usually is right. Anyway. New investors and traders especially, they want to predict the top, predict the bottom, predict the recession, predict the next 10 banger because being right feels so good. But the market does not reward you for being right, it rewards you for capturing moves, and these are 2 completely different jobs. And I'll give you some proof, right? Warren Buffett, the GOAT, he bought IBM in 2011 thinking he'd cracked the tech code. He fully exited in 2018 with somewhere between 3 and 4 billion in losses. His own words were, I was wrong in my original analysis. He bought US Air in 1989. He called that a mistake. A lot of people don't know this. He bought 20% of the world's mined supply of silver in 1997, sold it in 2006 for 100 million in profit. He later admitted that he sold way too early. That's the GOAT. Now look at Ray Dalio, one of the greatest investors on the planet. He famously predicted 2008, but that's not too impressive when you consider he was predicting 2008 since 1988. And in 17 years since the 2008 crash, he's been calling for another Great Depression, which just hasn't really happened yet, but he's still Ray Dalio, he's still making billions. Everyone gives these guys crap for being wrong. The point is that the GOATs are wrong constantly, but they still print money because you don't have to be right to make money in this game. You just need to position well and have some good years. And let me give you an example from my own history, right? I bought Nvidia in 2022 and I sold it for overall averaged out a 400% gain at the tail end of 2025. By the way, this isn't going to be a video of me bragging about my wins. I'll talk about my losses and my screw-ups soon. Anyway, I sold Nvidia for around a 400% gain in late 2025, overall averaged out. People give me crap because it's run another 10% or so since I sold it. They say I was wrong to get out. I don't care. I made my money. I cashed out. I took my wife on a nice holiday and I invested the bulk of it in energy stocks, which are way more than Nvidia's 10% is, right? And I believe that they're probably going to outperform Nvidia over the next 5 years anyway. So I was technically wrong for exiting Nvidia because I didn't time the top perfectly or whatever the knobheads say, but I got a lovely holiday funded entirely by my wins, and the rest of it is up on average 57% in the other stocks I invested in. So if I was wrong, I love being wrong. See, trying to eke out every last penny on a move and time the top so you can say I was right is a weakness in this game, which brings me to another point actually. Actually, you know what? Let's add this other point as a bonus truth. I'll do that at the end. We'll come back to it. Anyway, truth number 1. Summed up, focus on making money, not on being right. Don't try to capture every single percent of every single move. If the market gives you a gift, take it. Take some profit. Anyway, brutal truth number 2, don't chase green candles. You should position early or not at all. Every day I get asked, should I buy silver right now? Guys, the time to buy silver was years ago. Just look at the maths. And a lot of people are going to get mad at me for saying this. They're going to tune out. But just follow along here, right? From $20, silver had potential to go up 500%, 400%. From 120, it just doesn't. Same metal, same thesis, it's just a completely different trade. Look, I'm not buying silver. I'm not saying silver cannot go up from here. I think it will go up eventually. I still hold a lot of silver. I'm not bearish on silver. What I'm saying is new investors always make the mistake of chasing the hyped moves, but instead they should be looking for unhyped assets that have yet to become hyped. Your job is not to chase moves, and I'm going to talk about some of those assets. Your job is not to chase moves, it's to position early. Sometimes you position early into the wrong assets. See rule number 1 or brutal truth number 1. It's okay to be wrong. But every now and then, you're going to get a banger move like silver, and it makes up for all the bad ones and then some. But the one thing you never do is chase a massive pump, because that's when you have the highest risk of being too late and losing money. Like everyone who jumped into silver at $120 and they're now sitting on a loss. They might be sitting on a loss for years. I hope not. I hope it goes up, but they might be. So how do you position early? That's the big question. You have to ask questions. But that's the entire job of an investor. It's asking questions. You identify a structural force, then you trace the second order effect, the third order effect. I'm starting to sound like a textbook. In plain English, look at what's happening right now in the world, make well-researched predictions as to where that can lead, buy before it leads there, buy before it gets there. Now, I'm going to give you a couple of examples from my own research right now. AI first. So, and I'm going to explain kind of the history of the AI thing. Back in 2022, I asked a very simple question. What does AI need? It needs GPU compute. That's the food for AI. And NVIDIA provides GPU compute. That's why I bought NVIDIA. And I also bought AMD thinking it was the dark horse that would beat NVIDIA in terms of gains. I was wrong. I was very wrong. And had I gone all in NVIDIA, I would have made more money. But I split it between NVIDIA and AMD. Then I sold AMD at $220 and it goes up 50%. And since March, it's gone up like 50%. Or whatever. Anyway, that whole AI trade is now obvious. Do not chase that trade. Instead, let's talk about some plays that might, and I stress might, work in the coming year or two or three. It's AI again, but not NVIDIA. It's a few layers deeper. An investor's job is to ask questions, like I said. So let's walk through this process of asking questions. Question 1, what does AI need? GPUs, we already covered that. Question 2, what does running GPUs at hyperscale need? Power, massive amounts of reliable, dispatchable power. Question 3, what's actually scarce? It's not power generation in theory, but deliverable generation, deliverability of power. We're talking about transformers, switchgear, transmission lines, behind the meter gas, behind the meter nuclear. It's just all boring stuff. Industry analysts looking at the project pipeline reckon that roughly half of all the announced power projects through to 2030 won't actually get built. The bottleneck isn't money or demand, it's permitting and it's the grid equipment, right? Especially in the US, permission for building is a massive headache. Anyway, question 4, and this is the important question. Will these data centers actually be built? Now, like I said, some of them won't, but a lot of them kind of have to, because the Mag 7 have signed legally binding 10 to 20 year leases on the data centers. They've signed long-term power purchase agreements. Data center operators and hyperscalers were responsible for roughly half of all corporate clean energy power purchase agreements in 2025. These are obligations. They're not intentions, they are obligations. Even if the AI revenue story disappears next year, or if it disappoints, probably more likely, those contracts, they don't disappear. The power demand is locked in. So now look at where the capital actually has to flow. Multi-trillion-dollar build-outs weighted heavily to land, power, and cooling. 20 plus gigawatts of data center capacity is currently under construction right now. McKinsey is calling it a $7 trillion cycle. I think that's a bit overhyped, but you know, even if it's 1 trillion, that's plenty to make money from, right? Now, look, you might agree with me on this or you might disagree. If you disagree, drop a comment below. I'm interested in hearing your thesis. But what I'm going to say is, I could be wrong. See brutal truth number 1. Speak to a financial advisor about this, as this is just my personal analysis and I may have missed something. But the way I see it is the Mag 7 have signed legally binding contracts to build out AI data centers. Even if they have a few bad years, they will have to commit capex to fund these build outs. And they are doing that this year already. So I'm looking at the picks and shovels of the AI data center build out. Grid equipment makers, transformer manufacturers, HVAC for cooling these centers. HVAC is a particular one I'm interested in right now. So I'll give you an example. Vistra Energy Corp, VST, energy provider in Texas. Nextra Energy, or NextEra. I always call it Nextra. NextEra Energy, NEE, Florida energy provider. Look into HVAC too. It's too late for comfort systems. The ticker for that is FIX. But I'm looking for some HVAC plays that I think will catch up to FIX. So I'm going to be looking at that. Subscribe to my Substack, by the way. I drop articles on there daily, and I'm going to be exploring some of these stocks soon. It's completely free. There's a link below. Anyway, another idea related to this is copper. Right? Copper is up only 26% in the last 5 years, but the amount needed for these data center build-outs is absurd. Also, a lot of solar panel manufacturers are trying to switch from silver because it's getting too expensive to copper to cut down on costs. Copper is arguably undervalued. See, the contracts the Mag 7 sign for data centers are sticky. They need to find the money to build them or they're in big trouble. So I'm looking at the picks and shovels of the AI data center build out. I'm happy to buy now and wait a few years to see if I'm right. I might be wrong. This brutal truth went on for a while, but I hope you've learned something along the way here. Don't chase green candles, anticipate green candles. That's the summation of this truth. Now let's go on to brutal truth number 3. Cash is a position. Look, you don't need to be buying shit all the time. Like, you really don't. Right before I get into this one, I need to tell you something, right? I need to tell you something. I don't like cash. I really don't. I think a currency reset is coming. I think the US dollar is getting debased. I'd rather hold gold over US dollars, but cash is a necessary evil sometimes, because sometimes it's the practical move even if you hate it. And it's just a maths question, really. Here's how I think about it. I might lose 9% to dollar debasement this year if I sit in cash. I mean, it was 9% last year. I might lose 9% this year. That's not great. But if I hold something that's wildly overvalued, I might lose 50% in the same year. If I hold Nvidia, it could crash 50% this year. It's possible. So which one would I rather lose? Obviously the 9%. Also, there are some ways where you can hold stuff that's as good as cash without losing 9%, which I guess is, I should probably talk about that. I'll talk about that in a sec. Look, my point is most people feel like they are failing if they are not holding something and they're investors. But that feeling is a trap. You know what it actually is? This is especially true with new investors or traders. I experienced this when I was new. You feel like it's your job to be, as an investor or a trader, to actually invest or trade, to put money in the market. Not investing feels like you're failing, feels like you're not doing your job, but sometimes not investing is the best possible choice. Look at Warren Buffett. He's holding $380 billion in cash right now. If you're 100% invested all the time, you've got zero ammo. Greg Abel, the guy who's taken over for Buffett, the new CEO of Berkshire Hathaway, he said last weekend he's not anxious to deploy capital into subpar opportunities, and that there will be dislocations in the market, right? Buffett sat in the front row and nodded along. Look, he's not in cash because he's scared. He's in cash because the maths works out, because it makes sense right now. Now, while we're on this, I want to give you something actually useful, tips. I don't want to give you tips. Treasury inflation protected security. These are not a substitute for gold, and they are not a perfect inflation hedge. But if you're going to hold cash, you can hold it intelligently. I'll explain how tips work very quickly. The principal adjusts up with CPI. So when inflation runs, your principal runs with it. The 5-year tips at the latest auction came in with a real yield of about 1.367 with a break-even inflation rate of 2.58%. That's the highest break-even on a 5-year auction since October of 2022. There's a couple of caveats though with tips. The very short-term tip yields actually went negative right after the Iran war kicked off in February. And tips held inside a fund can lose money if rates move against you, but individual tips held to maturity lock in real return that beats inflation. And also tips aren't as liquid as just normal treasury securities, which is also a decent option, really. I mean, you could just get into treasury securities like Buffett is. Look, the point is, you just need to monitor the situation and be ready to get out of them if the dollar reset thing accelerates. I've been growing my cash position lately because I want dry powder to buy if the market crashes, and I have a bit of cash now. I have more cash than I had last year, right? Anyway, brutal truth number 4, no leverage. This one always gets ignored, so I'm going to spell it out properly for you. Leverage is the single fastest way to take a correct thesis and lose all your money with it. You can be right about the asset, right about the timing, right about everything, and leverage will still take you out. Why? Because the margin call doesn't care about your thesis. When you use leverage, you borrow against your position. If the price moves against you, you get liquidated, and then you get to watch the trade you were in move in the direction you predicted without you. It's a horrible feeling. And then there's the asymmetric maths. It's the asymmetry of the whole thing. Leverage magnifies your losses. A 5% loss for me might be a 50% loss for you if you're a leverage trader. Getting back to break even from a 50% loss requires a 100% gain, right? Getting back to break even from a 5% loss requires a 5.23%, whatever gain. That is a hidden trick with leverage, a hidden trap, not trick. And by the way, do you know how much leverage is in the system right now? US margin debt is sitting at 1.2 trillion. Margin debt is now 4.1% of the US GDP against the 50-year median of like 1.5%. So we're sitting at almost 3 times the historical norm. Every single time margin debt has hit prior peaks as a percent of GDP, what followed was a wipeout. 1929, 2000, 2007, that's just a fun fact. Another fun fact, 86% of leverage traders lose money. And that's the official number, but the real number is that over a 5-year period, almost 100% of retail CFD traders lose money. And how do I know this? I know this because that's a number from a friend of mine who worked high up as CFO in the CFD and CFO in the CFD industry, CFO for Forex brokers, right? So good luck beating those odds. Anyway, brutal truth number 5, compound the boring stuff. Look, this one, it sounds obvious until you actually try to do it. Wealth in this game does not come from picking the most exciting stocks. Wealth comes from not blowing up. The 99.9% of people who lose money in markets, they don't lose because they pick badly. Most of them pick just fine. They pick Nvidia, they pick gold, and they get the call right. And then they get greedy and they leverage it, they overtrade it, they round trip it back to where it started or way worse. Boring is not a downgrade. Boring is the alpha, right? Boring saved my ass in 2008 when half of my mates were getting ripped apart by the crash. It saved me in 2012 when the Eurozone was falling apart, especially then. God, that was a crazy. Anyway, it saved me in 2020 when COVID hit. The boring positions held for years are what build actual wealth. Gold since 2013, silver since 2013, Nvidia from 2022 to 2025, and I took over 400% there. But 400%, by the way, I should explain that because a lot of people are going to say, but it went up 1,000% or whatever. 400% because I took profit along the way. Obviously, I'm not just going to buy and hold and never take profit when something's like done like a 5x. But anyway. In this time, I also screwed up a lot. I mean, I had a position with Nike that cost me a bunch of money. Nike, whatever you guys call it. But I cut that position because my analysis was wrong. Nike was a bad play. Anyway, the 2 boring trades both took years to play out. And yeah, you might say Nvidia isn't boring, but it was boring to start with. It got exciting eventually. And when it got exciting, I got out because when it gets exciting, that's when everyone piles in and that's when it starts going bad. A lot of assets are boring for longer than you would expect, especially if you're in early. But if you develop a thesis and you are confident in that thesis, just stick to it, even if it's boring. The worst thing you can do is jump from exciting trend to exciting trend because some knob is shilling it on Twitter and lose 10% here, 20% there, 5% there, and then after 5 years, you end up with almost nothing. While the boring play you should have stayed in, all of a sudden pops off and you would have made 400% of that. Which this brings me to the bonus brutal truth I wanted to add to the end of this. It's just don't lose money. Warren Buffett says rule number 1 is don't lose money. Rule number 2 is don't forget rule number 1. And I've always lived by that in my investing. And that's it. That's the whole truth. I have lost money in my investing. I mean, like I said, just don't lose money. Every single one of the 5 brutal truths I've talked about so far, it reduces back to this truth, right? It's not about being right, it's about making money. Why? Because losing money to ego is still losing money. Don't chase green candles. That was brutal truth number 2, right? Because chasing green candles is the fastest way to lose money. Well, leverage is the fastest way. Chasing green candles is the second fastest way. Cash is a position. That was truth number 3. Because being in cash means you're not losing money when something is overvalued. No leverage. Why? Because leverage is the single fastest way to lose money permanently. Compounding the boring stuff. Why? Because the boring stuff is what stops you from losing money for long enough that compounding actually works and it has a chance to work. The way you make money in this market is by not losing money. I'll see you in the next one.